What if literally everything you've ever been taught about investing is just completely backward?
Right, like the whole buy low, sell high thing.
Exactly. I mean, we've all heard it a million times, drilled into our heads since we opened our first brokerage accounts. Buy low, sell high.
It makes logical sense. You hunt for bargains.
Yeah, you hunt for bargains, wait patiently for the broader market to, realize their true fundamental value, and then you cash out. But what if there was an entirely different strategy? What if instead of meticulously hunting for undervalued bargains, you just buy high and sell even higher?
I mean, it sounds incredibly counterintuitive
Yeah.
and, frankly, almost reckless at first glance.
Totally reckless.
But that specific philosophy is actually the engine behind one of the most heavily debated yet historically profitable anomalies in modern finance.
And that anomaly is exactly what we're unpacking for you today. So consider this deep dive your personal, comprehensive Wall Street analyst thesis.
We are going to evaluate the current business landscape of momentum investing.
Right. We've pulled together a massive stack of sources for you. Dense academic finance journals, historical market data wikis, all the way to real-time ETF analyst reports. We're going to look under the hood at the valuations and key multiples of specific momentum ETFs, compare them to their competitors, and deliver a final verdict.
And we should probably get the compliance stuff out of the way early.
Oh yeah, good call. I need to explicitly state, this analysis is for entertainment purposes only. Consult a professional for your specific case.
Compliance always comes first.
Always. But having the right framework to understand this strategy is critical because momentum investing isn't just like a niche internet trend.
No, not at all. It's a heavily documented financial phenomenon.
So let's start with the mechanics. According to the historical data, this strategy involves buying assets that have had unusually high returns over the past 3 to 12 months and strictly selling or avoiding those with poor returns over that same period.
Basically, you aren't looking at what the company actually does. You're just riding the statistical wave of its stock price.
Yeah. While it feels like a modern algorithmic trading concept, the roots go way back, right? Like Richard Dryhouse.
Yeah, Richard Dryhouse is largely considered the father of momentum investing. He operated on the belief that far more money is made by buying stocks that have already demonstrated upward price trajectories.
Right, he wasn't interested in catching a falling knife.
Exactly. But it wasn't just a singular trader's intuition. It actually gained massive academic backing. There's a landmark 1993 study by Narasimhan Jagadish and Sheridan Titman that proved this out mathematically.
And their numbers were crazy, right?
Yeah, they found that applying this strategy systematically, buying the recent winners and selling the losers, yielded average returns of 1% per month for the following 3 to 12 months.
A 1% monthly average return is massive when you compound it over years. But it kind of begs the question, why? I mean, stocks don't just go up because they went up yesterday.
Well, what's fascinating here is the behavioral finance aspect. To truly understand momentum, you have to look past the spreadsheets and understand human psychology.
Okay, lay it on me.
So some of the academic research we pulled reviews the empirical evidence of investor sentiment and asset pricing. And it heavily points to a 1990 theory by J. Bradford DeLong and his colleagues. They model the market impact of what they call noise traders.
Noise traders. So as opposed to rational investors who are actually trading on like fundamental data and earnings calls.
Precisely. Noise traders buy and sell based on hype, rumors, or quite simply because the stock's price is going up and they don't want to miss out.
FOMO.
Yeah, pure FOMO. They aren't running discounted cash flow models or reading balance sheets. They suffer from deeply ingrained human behavioral shortcomings like herding, overreaction, and confirmation bias.
I can picture this perfectly. When a stock starts doing well, it generates news headlines. Right?
Yeah.
And that news generates social proof.
Your neighbor tells you they just made a quick $1,000 on a tech stock.
Right. Suddenly, you have a herd of noise traders flooding into the asset out of pure fear of missing out, pushing the price far beyond its fundamental intrinsic value. And the momentum investors are just, systematically exploiting that exact human flaw.
They are literally surfing the wave of human irrationality. The noise traders provide the fuel, and the momentum strategy provides the surfboard.
Okay, I have to push back here, though. Because we have this foundational concept called the efficient market hypothesis,
Sure.
the idea that all known information is instantly priced into the market by perfectly rational actors. If literally everyone, including Wall Street supercomputers, knows about the momentum effect, Why hasn't this anomaly been arbitraged away?
It's a great question.
Like, why don't the rational investors just step in, short the massively overvalued stocks, and neutralize the noise traders before the bubble even inflates?
That is the core tension in modern financial theory. The simple answer is that arbitrage is incredibly risky and phenomenally expensive. There's a famous quote by the economist John Maynard Keynes.
Oh, I know this one. The market can remain irrational longer than you can remain solvent.
This is exact.
Meaning, if I try to step in front of a massive herd of noise traders to short a stock purely because its fundamentals don't make sense, that herd can still trample me.
Oh, they can push the price up another 50% before reality finally sets in?
Mhm.
And if you're shorting that stock, you will be margin called and bankrupted long before the market corrects itself and proves you right.
Wow.
So rather than fighting the irrational herd and risking bankruptcy, momentum strategies just follow them, capturing the upside of the bubble.
If you can't beat them, systematically exploit their behavioral biases. That actually makes a lot of sense. And that human tendency to herd leads directly to massive capital concentration in whatever is currently winning.
It definitely does.
So to see where that capital is flowing right now, let's transition from the theory and look under the hood of the actual financial products tracking this behavior.
Yeah, we have two heavyweights in the current business landscape to compare for this thesis.
Right. For our analysis, we are looking at the Invesco S&P 500 Momentum ETF. The ticker symbol is SPMO. And we're going to stack it up against its main competitor, the iShares MSCI USA Momentum Factor ETF, ticker symbol MTUM.
Right, MTUI.
So if we're evaluating these, we need to look at the key multiples.
Breaking down the data from our most recent analyst reports, SPMO is currently trading around $117.62. It has a price-to-earnings, or PE ratio, of 27.61.
Okay, and just to anchor that number for you, a historical average for the broader market is usually somewhere in the mid-teens. So a PE approaching 28 means you are paying a significant premium for every dollar of earnings.
Definitely. Now, SPMO tracks roughly 100 stocks from the S&P 500 that exhibit the highest momentum scores, and it charges an expense ratio of 0.13%.
So it's relatively cheap to own, even if the underlying stocks are expensive. How does the competitor MTUM compare?
MTUM is trading at $246.90. It has a noticeably higher PE ratio of 31.70. You are paying nearly $32 for a single dollar of corporate profit. Yeah. It casts a slightly wider net, tracking 125 holdings, and it has a slightly higher expense ratio of 0.15%. But the real story isn't just the sticker price or the management fees.
No, it's what these funds are actually holding inside. This is where the herding behavior becomes visually obvious. When you look at the sector weightings, MTUM is heavily concentrated in information technology. It's sitting at 40.90% IT.
And SPMO is also remarkably tech-heavy, with information technology making up 31.7% of its assets.
But the overlap at the very top of both funds is just staggering. We are talking about massive allocations to NVIDIA, Broadcom, and Meta. In SPMO alone, just NVIDIA and Broadcom make up over 18% of the entire fund's assets.
Which forces us to ask a pretty difficult question about the nature of these products.
Okay, let's unpack this. If we have two separate momentum ETFs, supposedly capturing a unique behavioral market factor based on price velocity, but they're both just holding massive concentrated positions in the exact same tech giants, are these genuinely capturing a unique market factor? Or have these just become really expensive glorified tech ETFs in disguise?
It's the defining problem for an analyst looking at this space right now. Momentum is inherently a chameleon. The strategy doesn't care about what the underlying company actually produces. It only cares about price velocity.
Right.
Right now, the velocity is entirely in tech, specifically AI and semiconductors. So by definition, a momentum ETF will morph into a tech ETF. But, and this is a crucial distinction, if tech stops leading the market, these ETFs are mechanically designed to ruthlessly sell those tech giants.
And buy whatever the new winner is, whether that suddenly becomes healthcare utilities or like consumer staples.
They will abandon the tech narrative the second the momentum shifts.
But right now, you as the investor are buying a tech-heavy portfolio at a very steep premium. Paying 28 to 32 times earnings leaves absolutely zero margin for error.
Zero.
And when that margin disappears, history shows us exactly how violent the fallout can be.
The music always stops eventually. Let's look at the current analyst sentiment from our sources, because there is a stark conflict here that you need to be aware of. On one hand, MTUM holds a Morningstar Silver Medalist rating and an overall 3-star rating.
That indicates a solid, historically respectable fund in the eyes of their analysts.
But then we look at the analyst reports for SPMO, and the tone changes completely. The Market Edge Second Opinion report explicitly issues an avoid rating.
An avoid rating.
Yeah, they note a deteriorating market edge score of -4. For context, -4 is literally the bottom of their rating scale.
Wow. Why is there such a massive red flag on SPMO right now?
It comes down to those exact high PE multiples we just discussed. When you are buying assets at these extreme premiums, you are pricing in absolute operational perfection from those companies for years to come.
Right.
Any slight miss in earnings, any shift in interest rates, and these ETFs become highly susceptible to sudden, violent reversals. In the academic literature, this isn't just a theoretical risk. It is a known, documented phenomenon called a momentum crash.
A momentum crash. So how does that actually manifest in the market? Because it's not just a slow bleed, is it?
No, it's sudden and brutal. It's the dark side of the herding behavior we talked about earlier. Momentum crashes usually occur during periods of market stress. Or, ironically, right when a bear market ends and the market violently rebounds.
Right, because momentum trades are overcrowded trades. Everyone is standing on the exact same side of the boat.
Exactly. If unexpected economic data drops or a sudden market correction hits, all of those noise traders panic. They try to rush for the tiny exit door at the exact same time.
And because absolutely everyone is trying to sell, liquidity completely dries up. There are no rational buyers willing to step in on the other side of the trade at those absurdly high prices.
The unwinding of these overcrowded positions causes sharp cascading price declines. The historical market data we pulled provides a chilling example of just how bad this can be.
Oh yeah, the 2009 data.
Right. In 2009, as the market was rebounding from the financial crisis, the losers that momentum investors had shorted or avoided suddenly skyrocketed while their supposed winners plummeted. The result: momentum strategies experienced a devastating crash of -73.42% in just 3 months.
Minus 73% in a single quarter. I mean, that kind of drawdown can permanently destroy a portfolio.
If we connect this to the bigger picture, momentum is inherently risk-prone because of financial gravity.
Yeah.
The higher the price goes, the farther the potential fall.
Yeah.
When capital violently rotates away from the current winners, momentum investors are left holding the most expensive, overextended assets precisely when nobody wants them anymore.
So knowing that a 73% crash is mathematically possible in this strategy, the logical next step for us as analysts is to ask about risk management. Like, is there a framework to surf the behavioral wave, but ensure we don't end up holding the bag when the tide unexpectedly goes out?
Fortunately, there is. We found a highly regarded framework in the research pulled from Composer.trade. It's a strategy created by Gary Antonacci called dual momentum investing, and it acts as a critical upgrade to the thesis.
Okay, so to understand the upgrade, we have to distinguish between two concepts. Traditional momentum, which is exactly what the ETFs, SPMO, and MTOM do, is technically called relative momentum. It just compares assets against their peers.
Right.
It looks at the S&P 500 and says, right now, tech is outperforming healthcare, so we buy tech. It's purely a relative measurement.
Think of it like being the fastest runner in a race. Relative momentum guarantees you are betting on the fastest runner.
But what if the entire race is taking place on the deck of a sinking ship?
Right.
You might be the fastest runner, but you're still going to drown. Relative momentum will gladly put you in the best performing stock during a brutal bear market, even if that stock is still losing 10% a month. It's just losing less than everything else.
Which is an incredibly frustrating way to lose money. And this vulnerability is exactly why Antonacci introduced the second factor: absolute momentum.
So how does absolute momentum change the math?
Absolute momentum doesn't care about the other runners in the race. It only looks at an asset's own historical return over a specific look-back period, usually a year. It asks a remarkably simple question: is the overall trend of this specific asset positive or negative?
Has the price actually gone up over the last 12 months, ignoring everything else in the market?
Exactly.
Here's where it gets really interesting. Dual momentum combines them both as a mathematical safety valve.
It's a two-step verification process. With dual momentum, you first use relative momentum to find the strongest sector, say, information technology.
Yeah.
But before you allocate a single dollar, you apply the absolute momentum filter. Is information technology actually generating a positive absolute return?
I see.
If we're in a deep bear market and the absolute momentum of the market is negative, a dual momentum strategy forces the investor to stay out of the equity trade entirely.
You ensure the herd isn't actually walking blindly off a cliff before you follow them. If the absolute trend is negative, the strategy mechanically shifts your capital into cash or safe treasury bonds.
Yes.
So by demanding that an asset has both relative strength and positive absolute momentum, you dramatically reduce the exposure to those terrifying 70% drawdowns. Plus, you cut down on the high transaction costs of constantly churning a failing portfolio while the market is sinking.
It transforms a strategy that is historically highly volatile into something much more robust. It acknowledges human psychology and exploits the noise traders, but builds a hard-coded circuit breaker to protect you from the inevitable crashes.
Which brings us to the final verdict. We've evaluated the landscape, the behavioral psychology driving the noise traders, the high multiples, and the severe drawdown risks. It's time to deliver the actionable conclusion for you, our client.
Now, in a standard Wall Street analyst thesis, this is the point where we would normally perform a 10-year discounted cash flow or DCF analysis to find the true intrinsic value of these assets. We'd map out a 9% growth expectation, set a 2.5% terminal growth rate, and apply a 10% discount rate against the free cash flow base.
But we have a unique challenge here. Because we are evaluating massive 100-plus stock ETFs, the constituent free cash flow data and specific growth projections for every underlying asset aren't provided in the ETF analyst research. We literally can't build a reliable DCF model for the entire fund without that base data.
Exactly. So without a DCF to give us a definitive intrinsic value, we have to base our verdicts strictly on the available valuation metrics and sentiment data we've analyzed today.
And those metrics are flashing some very bright warning signs. I mean, we are looking at PE multiples of 28 to 32, representing a steep premium compared to historical averages. We're looking at a heavily concentrated tech landscape inside these funds, meaning you lack true diversification.
Right.
And most glaringly, we have that explicit avoid rating from Market Edge for SPMO due to a rock-bottom deteriorating score of -4. Synthesizing all of this data, the short-term thesis for traditional momentum ETFs like SPMO and MTUM leans heavily toward a hold for current owners, or an avoid for cautious investors looking to initiate a new position.
The premium is simply too high.
The premium is too high, and the concentration risk in tech is too severe right now. The only exception to this verdict is if you are actively employing a protective, dual momentum strategy, using absolute momentum as your circuit breaker to guard against a sudden, violent reversal.
Why does this fundamentally matter to you? Well, whether you are actively trading these specific ETFs or just checking the allocation in your standard retirement account, you have to understand the core uncomfortable truth of this strategy. Winners keep winning until they violently don't.
Yeah.
Managing your own risk tolerance means recognizing the difference between riding a sustainable wave and just following an irrational herd into a fragile bubble. And that leaves us with one final provocative thought to consider about the future of this entire financial concept. The academic paper we reviewed on investor sentiment mentioned the rising use of machine learning algorithms, Google search volume analytics, and Twitter sentiment models.
Oh, algorithms that are literally scanning social media and news feeds in real time to gauge how retail investors are feeling.
Right. Historically, momentum has been measured in slow, human cycles of 3 to 12 months. It takes time for news to spread, for neighbors to talk, for the herd to form. But as artificial intelligence gets exponentially faster at parsing global human sentiment in milliseconds, will that traditional momentum cycle compress?
Will a behavioral trend that used to take 3 months to build now happen in mere days or even hours?
If the supercomputers can perfectly quantify the noise traders in real time, human momentum investing, as we've discussed it today, might become completely obsolete.
It raises an important question. The next time you feel the undeniable urge to jump on a crowded bandwagon because a stock just keeps going up, are you the one timing the jump? Or are you just the noise trader the algorithms are feeding on?
A fascinating and slightly terrifying evolution of the market.
Something to seriously ponder before you hit the buy button. Until next time.